Let's start with what's happening in the small cap arena. With all this excitement around global equities, the big rallies that we're seeing across the board today, are we seeing a similar movement in the small and mid cap space?
Not necessarily proportional, but it's trickling down, and it started to trickle down in the mid cap beginning of this year, and it's trickling even further into the small caps. So more liquidity is simple. The trickling will grow faster.
Is it a good time now then, if we're going to see catch up in the small cap arena, a good time to start looking?
I definitely think so, because what's going to happen is, from my point of view, is the money's going to flow into the emerging market. In the emerging market, it plugs into the top 40, because the foreigners don't understand our mid and small caps. That means they become expensive, and the locals start plugging into mid caps and the small caps. So the re-rating it started. We saw it sort of starting a couple months ago, and it's just going to pick up momentum as the liquidity goes.
Nick, are you already looking to the small and mid caps, or are you perfectly positioned?
Look, it's good to find bargains in the small cap sector. There's no doubt that sector naturally flies under the radar. I mean, there aren't many big institutional investors that will go for small caps due to the low volume, but you definitely get the private client or the retail client that will say, well, look, Billiton's up 6%. Is there a smaller, small cap miner that's out there as an opportunity? And if the fundamentals are good, that will eventually weigh going forward, and you could pick up some very, very good deals. A lot of the small caps do suffer from very bad fundamentals though, so you really have to pick the gems within that sector. There are a lot of dogs there, but there are a couple of diamonds as well.
And that's what we've discussed extensively, is how do you search out those 10 baggers of the future? And you've pointed out before that we've got to look at management, you've got to look at strong balance sheets. What else am I missing?
Management, profitability, solvency and liquidity. Those are the four key areas essentially that create a strong fundamental company. That said, then the share price has to catch up.
Frankie out with dramatically bad results. They were hammered last week. Any thoughts on your side?
Well, we've maintained our hold over it. The construction industry, I think, especially locally, is taking a lot longer to recover than people expected to or anticipated it to. Just the telling difference between the competitiveness in South Africa versus going into Africa. Frankie, essentially 75% of their revenue came from within South Africa, yet they only broke even. All of their profit essentially comes from out of South Africa, Pan-African operations, which was only 25% of revenue. So the competition is fierce, and Frankie being a nice leading indicator there.
Is this one on your radar screen?
Absolutely not. I mean, I've read a few reports about it, specifically now with the recent interim results that were out, and they were pretty shocking. I think revenue was down up to 90%, to 4.1 cents per share. So it's looking a little bit shocking at the moment, but I did pick up that a couple of the directors are buying, and then we've seen a little bit of buying coming through now in the month of October, late October, early November. So maybe on management side, they're thinking that the stock's pretty cheap at the moment, but currently with the research I'm reading, there's target prices of about R1.45, which is still about a 60 cent decrease from where we are now. I think just the sector with regards to small cap construction, it's really, really suffering at the moment. Companies like Sanyati and Frankie are still bleeding right now, and that just shows there is a huge competitive increase in our markets, specifically with the big construction companies like Group 5 and Marion Roberts that brought a lot of assets from overseas, where construction sector took a bit of a dumping and brought it back into South Africa, and there's just huge competition here. So maybe an opportunity, but not right now in my opinion.
Sanyati better than expected results out last week though.
Yes. The risk there always, because the market was pricing it for bankruptcy, so the risk was the market was right, which especially in the small cap arena is not always the case. You can't take an efficient market hypothesis and apply it there. Results were essentially 58% down on a normalized basis. That said, it's profitable, got negligible debt, and it's trading below tangible NAV. It's a simple net asset value play.
Keith, I know that this came out after you left your desk at about 4 o'clock this afternoon. Sun International saying that revenue for the quarter at 2.2 billion is 11% ahead of last year. They are saying that the demand within the gaming and the hospitality industries is anticipated to remain challenging. But after this trading update, the stock rallied 10%. It closed up 3% at 101 Rand. Any thoughts? I know, as I said, you haven't had a chance to look at this, but any thoughts on Sun International?
I think what's happening here is the market has rallied far, and guys are following the positive news over and above the market. So you're seeing a lot of opportunistic buying, and it was obviously profit taking down. That's why it closed a lot lower. Gaming industry is robust, and Sun International has a fantastic stake through it. But that said, it's an interesting movement. It'll be nice to see how it stabilizes over the next week or two.
Keith, thank you very much for your time. Keith McLaughlin, small caps analyst at Standard Bank. Old Mutual, third quarter trading update out of that company. And surprise being expressed by Julian Roberts at HSBC, the way that HSBC walked away from the deal without actually notifying Nedbank or Old Mutual. I think it hit the papers before either of those parties knew. Their plans, again, a very mixed message coming out of Julian Roberts saying, they're committed to Nedbank, they support the changes that are ensuing on that front behind the management team.
Any comments on that one? Hey, you always ask me about
Old
Mutual.
Questions.
No, always the insurance companies, and I keep on saying I don't really look at insurance companies in general. Look, I mean, obviously it was a bit of a shock. Everyone thought HSBC was going to take out Nedbank, and we know the connection between Nedbank and Old Mutual, and we've seen a large decrease from 150 Rand on Nedbank to about 130. It's probably up a little bit today. Some punters coming in at the moment, but other than that, I mean, I'm still negative against most insurance businesses. Just generally speaking, I find it very difficult to value them going forward. And that's what I've been saying all the time. I like to buy something that I can value, something I can see, something that's tangible, which is always a lot easier.
And the banks don't work for you either, do they? Well, you're a resource man.
No, look, I'm a resource man, and I'm also an industrial fan as well. And I like South African companies that have large exposure to emerging markets. I mean, companies like Richemont and Naspers. I like to keep it simple. In this kind of environment that we are in, it's very, very difficult at the moment. And just speaking about banking stocks in general, I still think they're in a very tough environment. I mean, you've seen Standard Bank get rid of 2,000 employees to keep costs down. I mean, that's massive. Everyone's speaking about the whole economy turning around. It's not. There's a massive disconnect between the real economy and what's happening on the stock exchange at the moment. And that's going to have an impact when we are wanting to invest in stocks. So to speculate, it's fantastic. You can speculate with Old Mutual and you can speculate with Nedbank and so on. But with regards to actual investing, I would much rather have a Billiton and an Anglos and a British American Tobacco and a Richemont on my account than have a Nedbank, a Standard Bank and ABSA. All that said, within that sector, I do believe that there's a lot of growth potential in the micro lenders like African Bank and Capitec. Now, I've missed out on Capitec. There's no doubt. But I've always said that.
Is it too late to get into Capitec? Could we not see
the analysts say no. I mean, I look at it. My goodness, it was 30 Rand the other day. It's now 150 Rand. Analysts are pointing to 200 Rand. So in that respect, it's worthwhile going for. My opinion is I've always stuck to the roots of African Bank. I just like the mix that they've got there. I think Ellerines has become an integral part of the business, and it's going to actually prove to be a benefit for the business going forward. And I like dividend yield. I like chasing yield currently, and the dividend yield from Capitec is relatively non-existent at the moment, where African Bank are getting 5%, sometimes 6%, depending on where you buy the share. That's pretty decent, and that's what I'm looking at. I'd much rather have my exposures there. Getting back to banks, Remgro is a good option to go for because they've got an indirect exposure to First Rand and Rand Merchant Holdings. So I'm taking a bit of an indirect move into the financials, happy with that. But going directly into banks, it's still not a favorite of mine.
The big theme that we've been speaking about of late is that the resource stocks, your favorite
My
arena,
favorite, here we go.
are going to push us through that 33,000 point level, perhaps even to a new all-time high on the JSE All Share. Is it worth taking the risk right now on the back of the momentum?
Well, I think the thing is you need to understand that if we look at the JSE, the majority of that is made up of Anglos, Billiton, and a couple of other major resource shares, and then some major industrials. But literally 30 to 40% is Anglos and Billiton. So if those stocks are going to rally and rally hard, then we're going to see the JSE back to 33,000 points purely because of how it works. If we have a look at the sectors and we break it down, we can actually see that the top 20 resource index still has a long way to go to reach levels where the JSE was at 33,000 points, if you understand what I mean. Where we've got the financial index that's way above what the JSE was like when it was 33,000 points before we crashed. And we've got the industrial index back on par with that. So the index that is showing the greatest value, if we look at it, or the index that has the largest amount to catch up, is the resource index. And maybe that's what we're seeing now. Yes, we've got massive stimulus from the American government that's helping that along. We've got resource prices through the roof.
You like that term, liquidity supernova, didn't you?
I like it. I think it's brilliant. It's like the credit crunch and all these terms that you guys use. But I think it's perfect. It's a really, really good way of describing it. Even if it's artificial, it's still going to work. It's still going to have an impact. And having a look at pure value, most probably the best value is still in your resource sector at the moment, in my opinion.